Week 7 of documenting my trading journey. This week, I focused on developing strategies around momentum and volatility. Today, we'll look at last week's goals, the sentiment for the past week, the strategies I developed in QuantConnect, forward testing, ways to avoid overfitting a strategy, takeaways from my readings, and then goals for next week. Last week's goals were to develop 2 strategies in QuantConnect. I did that, the momentum and volatility one. Apply forward testing. I did that in 2 ways, a bootstrapped Monte Carlo and a forward projection Monte Carlo. And then explain 3 methods to prevent overfitting. I came up with 5. Speaking about overfitting, that continues to be the biggest issue that I'm facing is how to optimize a strategy without overfitting the sample data. However, I've come up with some different ways to hopefully remedy this that we'll go over later. This week, I again stayed in this 1-3-5 range, except what was new was actually tapped into step number 6 and used bootstrapped Monte Carlos and forward projection Monte Carlos to predict probability of future success. This is the strategy I ended up picking for the momentum trading. I liked this one because it focused on low frequency trading, and without the resources of Citadel or Jane Street, I can't really execute a successful high frequency trading strategy. So as we can see, the strategy in this paper was tested over the time period of 1986 to 2006, and this becomes an issue later because I think it may be outdated, or I just tested it over too small of a time frame, but I did not get the intended effect or outcome that was outlined in this paper. These were the results of the momentum strategy after I coded it in QuantConnect and then backtested it over 10 years. As we can see, less than ideal, only a 6.5% return over 10 years and a negative Sharpe ratio. Something interesting is it actually has a very high win rate at almost 70%. That's significantly higher than any of the other strategies I've tested. But as we can see, when it does go in a down period, it drops pretty sharply. So here we can see the FX pairs that were chosen for this strategy. This may also have been part of the issue. It was supposed to only be pairs that were against USD, and we did end up having some pairs in here that are, USD first, which would have the opposite effect on the strategy, especially if it's designed to only be trading pairs that are against USD, because obviously these pairs are going to be inverse if the USD is the driving factor, and so it'll cancel out any large effect. Something interesting that I noticed was the correlation between the equity curve of the strategy and the market as a whole, especially the domestic USD market. So as we can see, we have the equity curve of the strategy on top, which should be something against USD. And so it's going to be inversely correlated with the market at large. That may be wrong, by the way. That's what I think. As we can see, as the S&P takes a huge hit, the equity curve of the strategy jumps up dramatically. We can see this again as the S&P has a relatively flat period. The strategy also has a relatively flat period, but in a slightly different direction. Starts climbing up. Then the insight that this led me to is that I need to create a regime-changing strategy. Now say this was the opposite of this and it was USD first, it's a momentum-based strategy. So in bull markets, it performs very well. And then in bear markets, it performs poorly. And I had seen this before, but I had never actually seen the effect of it on an equity curve of a strategy that I actually developed. And so after seeing this, I want to create a regime-based strategy where there's just a binary flip, just 0 equals bull, 1 equals bear. In a bull market, use momentum strategy. And then in a bear market, use a mean reversion strategy. Now, I think the trickiest part here is the switch itself from 0 to 1. There has to be some sort of delay or some sort of cushion in the middle so that the strategy is not constantly flipping from bull to bear if it's right in between, or risk on, risk off, risk on, risk off. So the next strategy I developed in QuantConnect was about volatility. This was interesting. It took a lot and reminded me a lot of my statistics class. It was very much upper band, lower band, using the standard deviation. Given that if there's an outlier, then that's considered a breakout. And then you use the simple moving average to decide if you should take a long off that breakout or a short off that breakout. Like this looks like the exact way we would create a box plot in statistics, which is pretty cool. You take the simple moving average, it's an average, and then plus 1.5 standard deviation minus 1.5 times standard deviation, and then that is your box in the middle, and you have your average there, and then your outliers. If price comes outside of this box, then it's a breakout, and then you can take a position off of that. This was just very cool for me to see in practice of knowledge from the classroom being able to be applied in my trading. The strategy itself, however, performed very poorly. Over the course of 3 years, it was pretty stale for the first two. Did end up climbing, but all in all, only returned a net profit of about 2% over the 3 year period, which is significantly less than the risk-free rate. So this again would have a negative Sharpe ratio given returns of the asset minus returns of risk-free rate. This in the numerator would be negative, so we would have a negative Sharpe ratio. I could have optimized this strategy, but I'm trying to stay away from that to prevent backfitting. If the strategy is not profitable in excess of the risk-free returns, there's not a huge point to optimizing it. The only way to make it profitable would be to backfit it to the sample data, unless this was an extreme outlier. However, given that it's over 3 years, that's a long enough time period to where it likely is an issue with the strategy itself, that it is just not a very profitable strategy. So now looking at different types of forward testing. Here we have the reshuffled Monte Carlo from the first trading strategy that I developed in multi-charts. However, this is just the trades shuffled up into a different order. That's why the starting and ending equity is the exact same. It is the exact same trades, just in a different order to illustrate the fragility of the strategy and the potential drawdown that could occur. Now, that's not really what I was looking to do. However, what I didn't realize is that this distribution analysis in multi-charts is a bootstrapped Monte Carlo. Or at least that's what it said online when I looked it up. So this is not only the trades shuffled up into a different order, but it is sampling with replacement when shuffling. So it could be C, C, D, D. When reshuffling, picking a new order, it can also pick the same trades multiple times. Given that, it produces a CDF graph, which, again, able to take my knowledge from stat and apply it here, which is interesting. Which here, if we look at the 50th percentile, so 50% of the iterations of the 1,000 trials in this distribution analysis would have a net profit lower than this number, and 50% would be higher. The 50% mark for this given strategy, the net profit is around 45,000, and then the 25th percentile here is about 25,000, and the 75th percentile was not much higher than the 50th, actually, at about 57,000 in net profit. So there's not actually that much variance from 25 to 75th percentile. However, this part of the graph is really interesting. There's a huge amount of variance in this last 10%. So only 10% of strategies have a net profit in this range, but this range is huge, from basically 70,000 to 170,000. I'm not sure why, if the range is so extreme on this end, in the positive direction, it is not equally as extreme in the tail end. And the reason I think that is that this strategy was developed for a prop firm. So there's strict intraday drawdown limits and account resets if there's too much drawdown. So it dramatically hinders the loss. However, there's really no hindrance on the profitable returns. And this is why you can have a strategy with zero expected value and still make money on prop firms, because your losses can be hard capped while your wins can grow theoretically uncapped. Now, in reality, they are capped at a certain point, but not hard capped in the same way that the drawdowns are. So I think this curve is actually beautiful to demonstrate the value of prop firms and prop firm strategies. Here I did the same thing except with the second strategy that I developed. However, we can see the strategy is not very profitable. A lot of drawdown risk. I mean, it pretty much dumps over the first half of the backtest. You can see the 50th percentile, the net profit is essentially zero. And the drawdown is not dramatically outsized, only on the positive direction. It is closer to equal on the positive and negative side. Still larger, the top 10%, than the bottom 10%, but not like the last strategy that we saw. The next type of forward projection that I did was a forward projection Monte Carlo simulation. So generating synthetic data and then projecting trades that the strategy would have taken on that synthetic data. I did this in QuantConnect. I do not think that multi-charts has a feature to do this. The strategy that I used was the volatility one. Probably should have used the momentum strategy. It looked more promising, but this is just for the practice anyway. So I think that this is an interesting process of how the code was able to do this. So first, pulling the historic data, because it's going to generate future data, but it needs historical data to base the future data off of. Then the next step, generating future synthetic data. Here we can see the number of simulations, the number of days that it's going to do. And then after it generates that synthetic data, it's going to run the strategy over that synthetic data. And then lastly, it is going to compute the different percentages and finally return back to us the result of the forward projection Monte Carlo. So this was really interesting because in the instance that we actually tested with the historical sample data, our net profit was about 2,000 over the given time period. Now, after running the forward projection Monte Carlo simulation, we can see that that would be about the 5th percentile, whereas the median net profit for this strategy using the forward projection Monte Carlo is significantly higher, and 13%, that's still not great over 3 years at all, but it is reasonable. And then, of course, the 95th percentile is going to be phenomenal, but I don't think that's as valuable to look at. So like I mentioned, overfitting to the sample data has been the biggest problem that I've been running into so far. Looking to optimize my strategies, and I end up overfitting to the sample data, and it feels good because net profit goes way up, but that's because I'm essentially cheating. So I came up with 5 ways to hopefully prevent this. The first way I heard about is finding robust areas in the 3D graphs of net profit. So if you were to have a 2D graph and pick one point with the highest net profit, that would 100% be backfitting. And picking a robust area is still backfitting, just less so. So it's not just picking one point, it's this whole area is way more profitable than the rest. This is still not even a great example because this graph is mainly 2D with the variation. But if we look at this graph on the right, this is much more 3D of a 3D graph. And we can break it up into 2 main areas. If we just discard this back half, we can then look at, okay, this front right quadrant is an area where the combination of these 2 different variables is profitable, not just at one point, but when they're both in this range. If they're both in this range, then the strategy tends to not be profitable at all. And then picking inputs for the variables in a robust range, if you are going to pick inputs, which may just be something to avoid entirely, picking inputs in a robust range would be the way to go, as opposed to picking inputs on a 2D graph. The next idea to prevent overfitting is something I alluded to on the last slide. Just don't iterate at all. Code the strategy once, and then if it's profitable significantly, okay, maybe you can iterate a tiny bit. But if we look here, this strategy had a negative net profit. And yes, it was over a period where the benchmark also had a negative net profit. However, this strategy is likely not worth it to optimize at all. Now, I was able to optimize it and create, a strategy that had positive net profit over a period where the benchmark had negative net profit, but that was through inevitably a lot of backfitting. And I think that may be a principle that I want to stick to, that only optimize it if it's already profitable out of the box. Because if not, and there's a saying for this that I can't remember right now, you're trying to essentially dress up something pretty that is already garbage. You can try your best and you can make it look good, but at the end of the day, it's still garbage inside. So I think I need to spend dramatically less time iterating and optimizing and more time just trying to find strategies, build strategies rather, that are profitable out of the box. The next idea is going to be using different samples. And so this is just the idea of in-sample data versus out-of-sample data. I kept seeing this acronym, OOS, and it's just out-of-sample data. This makes perfect sense to me. Seems like probably one of the best ways to prevent overfitting. What's difficult about it is there's no super easy way to do it on scale, especially in multi-charts. If I have to load a new sample range every time, especially on the free version, I only have access to so much data going so far back. But it does seem the most robust. Just choose the same asset at different time periods. So here we have a period, it was tested over about 7 months. Well, if that's promising, test it over a different 7-month period. Test it from, the 3rd month of 2025 to the 10th month of 2025. And then if that's promising, go 7 months before that, 7 months before that. You can vary the ranges too. Then you try a year and a half, then you try 4 months. And just varying the samples with the same strategy and the same asset to see if it is promising across different time frames or if it just happened to perform very well in that given market. Then what we are doing this week, forward testing. This is similar to using out-of-sample data. However, the out-of-sample data is not real. Generating synthetic data based on historical data and then applying the strategy to that synthetic data. Now, I'd love to hear people's thoughts on this because I'm not sure if that is a bad thing to do, if that's going to lead you awry, or if the synthetic data translates well to real potential market data and market instances that could happen. So I'll definitely have to look into it more of how robust is it to test on synthetic data with a, like we have here, forward projection Monte Carlo. Is that actually indicative of future performance? I'm not sure. Then lastly, make it simpler. I've already found success doing this when iterating a strategy, not even optimizing it yet, just writing it. As you tend to write more and more and implement different bits, fluff tends to accumulate, and the actual principle of the strategy that it's supposed to be created around gets muddied up and lost in all the fluff. I found that stepping back on what is the principle that this strategy is based around? Why is it supposed to be profitable? A great example of this is an algorithmic strategy that essentially automates buying the dip. So S&P 500 buy and hold works if you just dollar cost average invest the same amount every day. It works better if you invest the same amount of money, but you only invest after a 5% drawdown, random arbitrary number. But that is a easily automated strategy, and you could very quickly overcomplicate it. But what's the idea? If the market goes down, that's when you should put your money in the S&P 500 because it will return, and that's a great time to buy. So if that is the point of the strategy, just keep it that simple. And that's an idea I definitely want to focus more on, is when it's simple, keep it simple. Do not add the extra fluff. That is a great way to overcomplicate. The more parameters you have, the easier it is to overfit to historical data. Keep it simple. This one doesn't really fit in with the rest, and it's not really what I had in mind. But I realized, well, yeah, that is probably the most robust. Because what I was thinking is, how do I prevent overfitting before I live test? But I could also just live test with fake money. I mean, that would, in theory, be the most accurate, the most robust. Now, it doesn't give you a lot of simulations. You can't generate 1,000 trials of synthetic data and run it over those 1,000 periods. It's essentially giving you one trial. However, that one trial is actual market data, but it never happened before in those exact instances. So this is one, I totally could try. If I try everything else to prevent overfitting, I'm confident in the strategy, then deploy it live. But with fake money first, see the results, and then deploy it with real money. Again, though, my biggest concern with this is that it is just one trial. Biggest takeaway from my reading. So, the big thing to invest in was AI. Invest in AI. But now that is super inflated. The market cap of all these AI companies is just flying through the ceiling. So then it was, okay, we're in the gold rush of AI. AI is the gold. Buy the pickaxes. For example, Micron, that went up 1,000% over, I think, the past less than 5 years. They're making the chips for the AI, the pickaxes for the gold rush. Stole that analogy from a friend. Works very well. But now even those, as went up 1,000%. That is priced in or overpriced in the market. So what's the next segue? Well, the infrastructure and the companies that build the infrastructure for the AI, not in as direct way of, okay, who provides the pickaxes to mine the gold, but who actually owns the gold mine. Invest in that. There's going to be projected $7 trillion invested in AI over the next less than a decade into AI data centers specifically. So the companies that are building those data centers could be in extremely profitable position to take. For example, a company that builds large scale electrical systems. And I've heard this a lot before. Oh, invest in the power. There's a huge power demand for AI. But it's not just that, specifically for the data centers. Not just like Old Dominion Power, who provides the power, but literally like the electrical components that are needed to build a data center, beyond just the chips. That seems like a lucrative position to take at the moment. Then, lastly, still not sure what to do about the bubble. I think people, they see, oh, a bubble's coming, and so they sell their investments, and then they just keep waiting for it to come, and it doesn't come, and it's like, wow, I missed out on all that time in the market. Sometimes the best action is no action. I think I still do want to restructure my portfolio for more international exposure, but beyond that, I think honestly just taking the hit may be the way to go, given how young I am, how long the time horizon is. Don't overcomplicate it. Like, the market goes up and down. It's been going up for a while. Will it probably go down? Yeah. Just kind of take that hit, wait for it to go up again. When it does go down, buy more. That may be a very naive mindset. That's at least where I am right now. So next week's goals, I want to develop that regime-based strategy that I was talking about. That is momentum in a bullish market and mean reversion in a bearish market with a binary flip, 0 or 1 is either bearish or bullish, and then a little bit of cushion so it's not flip-flopping back and forth. Next, I want to explain logical fallacies or common pitfalls in quant because I keep falling into them. So hopefully I can learn to better identify and explain them so that I can avoid them. And then lastly, that biggest key piece to prevent overfitting, I want to utilize that and I want to create a strategy that is going to be profitable out the box, and then maybe I do optimize it, maybe I don't, but it needs to be profitable somewhat significantly upon creation. And so I think I need to put more effort into the creation part of the strategy, way less into the optimizing. Then, as always, keep reading about financial news and what's going on in the markets. The typical disclaimer: this is purely me documenting my learning. I'm in no way an expert, and this is definitely not advice.